The webinar will begin shortly.
Crowd on today, but that's okay. We'll get in some good interaction. Let's do a sound check real quick as we normally do. Make sure that the sound's coming across okay. My voice is loud and clear. You can see the current splash screen that says Understanding the Bigger Picture. This is part 3 of the 4-part series. And if you guys can hear and see me all right, just let me know via the question box on your screen. Give me kind of an electronic high five. And at least I'll know I won't have to change anything on my end before we jump into the content here. And what we'll do as normal is we'll record this thing from beginning to end. And shortly after the session, you'll get an email with a private link. You'll be able to view everything at your leisure. Those parts that you may have missed, sections you have particular interest in. We find that folks need to see these sessions a couple of times before they kind of come to grips with everything that we're doing here. All right, great, guys. Looks like everything is good. So if you'll excuse me for a minute, I'll get that recording fired up. And I'll be right back to do a formal introduction for recording purposes. And then we'll launch right into the content for today. Hello, everybody, and welcome. I'm Toby Gennaro, and I'll be your presenter for today. The topic for today is understanding the bigger picture. And so I'm going to be discussing today a deeper element of price action and show you how we layer the technicals to form the basis of our trading strategy. So we'll look at multiple time frames today. We'll look at indicator convergence and divergence of a trend and get a better understanding of how to combine all these factors together for an actual trade setup. So as part 3 of this 4-part advanced education series, we will begin today with a continuation of the technical ingredients of the strategies, and then we'll pull it all together at the end here with the strategy application that's yet to come in part 4 next week. So for those of you that are on the live webinar, if you have questions during the session, please do type those into the box on your screen. I'll be asking you some questions as well. We'll definitely keep this interactive. If you happen to be watching this via recording in the future and you have questions, you'll be able to send those as well, and I'll have some contact information for you at the end of the session so you can do that. And I just need to put up this risk warning and disclaimer. I know you guys have seen this quite a few times already. We'll try to breeze through this a little bit. But I'll leave this up for about 30 seconds or so. What this is saying in brief is that we provide education only, which means we do not give any financial advice. And as most of you know, trading the markets can be risky. It's not suitable for everyone, and you should seek independent professional advice. And if you can't accept these terms, we ask you to please cease watching the presentation and consult our website for more information. Okay? And then one more disclaimer here from Trade with Precision. If you can have a quick read through this one. Realize you guys have already seen these, but let's give you a few seconds here to review for those folks that may be new. Okay then, everybody good? All right, so this webinar is brought to you by 2 organizations. You guys have seen this all before as well as part of this introductory stuff. Oanda is the broker, really pioneered online foreign currency exchange and Trade with Precision. We are contracted by Oanda. We are a group of traders that trade for a living, and we teach our strategies on behalf of Oanda to folks like you. All right, so today in part 3 of our series on trading strategies, we'll go ahead, we'll spend our time on layering the technical factors like the moving averages, the indicators such as the MACD and the RSI, onto your understanding of trending price action and what we've been talking about the last couple sessions. So we'll utilize indicator convergence and divergence to get a better handle on price momentum within our trends. And what this will do is this will help us to understand how much further price may continue in the current direction and whether that trend is currently at its strongest or if it's showing some signs of weakness. So we've been talking about multiple time frames here and kind of here and there throughout the series, and now what we're going to do is we're going to take a deeper dive into understanding how multiple time frame analysis can support our trading decisions. So when we build our trade idea across a series of time frames, it can then improve the probability of our trade setup and give us more confidence in our decision to enter a trade, to stay in the trade longer, or to move to the sidelines. So we'll then go ahead and look at some practical examples of how to combine all of our technical ingredients to formulate a trading strategy, and then I'll show you how that works and the benefits of doing that. Then we'll go ahead and we'll wrap up with the final part of our series and what you can expect to happen for next week. Indicator convergence and divergence is helping us to measure the strength or the weakness of the current trend, which, by the way, we already know the strength from the price action and the fanning the moving averages, right? So the indicators then become really just another level of confirmation for us. So these strategies are built upon confirmation after confirmation and we're really layering on all of these ingredients to formulate this higher probability trading strategy. Now, as traders, it's our job to find the momentum in the price action. Okay, so we're kind of like hunters and stalkers looking to spot that momentum so that we can capitalize on it for a potential profit. So many times I'll get the question, hey, Toby, what is price momentum? And price momentum is really just the flow of buy or sell orders in and out of the market. Or another way to kind of think about this is it's the flow of money into or out of a particular market. So if money is being taken out of a market, then investors are selling to recoup their risk capital. And if money is being put to work in the market, then there's a flow of new money in the form of buy orders for that particular market. And this activity either drives prices higher or lower and creates the price action trends that we subsequently see on the charts. Okay, so a lot of folks are always interested in, what are the big players doing? Hedge fund managers, mutual fund guys, Goldman Sachs, or other big trading firms on Wall Street. And the way to think about that is you're never going to know what those guys are doing. So don't worry about it. On average, it will take the big players, literally weeks to move money into a position because they're managing, billions of dollars. So the big players are watching each other on Wall Street to see what their competitors are doing. But as a person just trading for your own account, you really don't need to be concerned with those big guys, since you can readily see what these players are doing by just looking at price momentum in the charts that we're looking at. You want to remember that price is king, and price tells us what others are doing in the market. Okay, you can't take billions of dollars out of a market and not have that activity show up in the price chart. Does that make sense to you guys? A lot of folks get really confused on that one, and they think that the market's rigged against them and other people know stuff, and that's just really not the case. So in looking at the price momentum here, we can see that there's new money coming into this market where the downtrend begins to run out of steam by creating a higher low and then a higher high that we can identify by the price action. So just by looking at price alone, okay, we can identify the exact price where the downtrend actually becomes a new trend, which is at the higher high. Okay, so this is a very orderly trend right here, simply meaning that it's predictable price action, steadily moving higher with consistent buying pressure. And that buying pressure creates trading opportunities for us. Okay, so it doesn't matter who's buying the market or why they're buying, we're just trading with that momentum in the market that we're following. And then there's a point where the buying gets tired, or investors begin to see more downside than upside to this trend, and price momentum begins to run out. And so we know that by the lower high confirmed by the lower low, and then at this point it's time to stop buying the uptrend because we no longer have higher highs and higher lows. Make sense? So as we've been talking about in this series, we measure price momentum by analyzing the strength of the trend and the strength of the moving average patterns, which really gives us a lot of confidence that we'll be trading in the direction of the order flow. Now we can get a secondary measure of momentum by using the indicators, the MACD and the RSI, and this is termed indicator momentum. Okay, so first, as we've been talking about, we need to determine a strong trend by comparing the highs and the lows of price, and the price action is what determines the trend, not the indicators of the moving averages. Okay, and then we want to see the structure of the moving averages to determine which stage the trend is in. Is it early stage or late stage? Since we don't want to be joining a trend late in the cycle. Okay, another layer of confirmation then comes from our indicators, the MACD and the RSI we talked about, which gives us a further measure of that momentum strength. And here's what we're really trying to do, right? We're trying to find the most reliable trades, and typically those high probability trades occur when both price momentum and indicator momentum are in agreement. And this term is then known as convergence. Okay, so price and the indicators are converging together in the same direction, making higher highs in an uptrend or lower lows in a downtrend. So in the same way that we are looking for higher highs and higher lows in the price action, we're also looking for that same characteristic in the indicators, the MACD and the RSI. Okay, so we're then comparing the highs in price with the highs on the indicators, or the lows in price with the lows on the indicators, to determine that indicator momentum or that convergence. So to get this indicator convergence on our charts, what we do is we set up our charting package using the MACD and the RSI indicators. So we're not trying to sell you any fancy new type of indicator. These are just standard indicators right out of the box, and they exist on your current trading platform, whatever that may be. So save your money when anyone tries to sell you another indicator. It's usually just kind of a marketing ploy. Proprietary indicators really do nothing to help your trading. If anything, they probably, I think, hurt you more than they can help you. Now for the MACD and the RSI, we just use the standard settings as they are when you add them to your charts, so you won't need to change anything there. But here are the settings anyway in case you want to double check your charts if you happen to be using some of these indicators already. Now I've mentioned this before, just let me say it again. We do not use these indicators traditionally. Okay, so we actually use them in a different way apart from the obvious buy-sell signals that they do generate, because I think as many of you guys know, these signals tend to be lagging in nature, which means they give their signals once price has already moved. And that's why it's hard to make money with them, right? The buy-sell signals are just not a very good predictor of future price action. So what we do with them is we use them as leading indicators for both convergence and divergence of a trend, and that's all we use them for. Okay, so if some of you are thinking, hey, why don't we sell right here when the MACD line crosses over, or when the moving averages cross over, or when the RSI gets in an overbought or an oversold zone. And for starters, the line crosses just don't provide a precise entry or stop location for us to trade off of, right? It's first and foremost. And many times those line crosses will generate a lot of fake signals when the market is in a strong trend, which is really the most important for us as trend traders, is staying with the trend, staying on the right side of that order flow. So you'll notice that the RSI will stay overbought for a long period of time whenever the market is in a strong trend. In fact, even a diverging RSI will take some time to turn around even when the trend is strong. Okay, so generally speaking, indicator buy-sell signals are something that you really want to stay away from. What you want to do is you want to learn to master the underlying price action, because remember, price is king, right? Now, if any of you guys have any questions on any of the slides that I'm going through, just feel free to use the question box on your screen. Shoot me over a question. I'll be checking that pretty much after every slide. And if I've misstated something or need to correct something, or if you didn't understand something, I'd be more than happy to help to clear it up for you on the spot and catch that question while it's still fresh in your mind. Okay? Okay, so moving on. So there's a better way to use these indicators now to give us an indication of price momentum. Okay, we're using these indicators as leading indicators by observing the convergence and the divergence between price and the indicators, as I've been talking about. And what this means to us is that as a leading indicator, we get notified of the possible price direction before price actually makes its move. And that way we're predicting the next move in the market instead of chasing the price action. So if convergence between price and the indicators tells us the trend is likely to continue, then divergence between price and the indicators will tell us that the trend is potentially weakening. Okay, so divergence across multiple time frames is going to keep us out of momentum breakout trades, while the trend flow trade can still be traded with some indicator divergence on the charts. Okay, so we're then disregarding the following indicator signals. We are ignoring the RSI overbought and oversold signals along with any MACD line crosses that occur. Since the buy and sell signals generated by these indicators, they're lagging in nature, and we don't want to confuse ourselves with how we're really using these tools. So some folks we've worked with, just they were so used to trading those MACD line crosses, we actually had to reconfigure the indicator and actually remove one of the lines so the person didn't have a reaction to it. And the same with the RSI. You can reconfigure the upper and lower limits to begin to retrain yourself to not react to these types of indicator signals. So get in the habit of predicting the next move in price and not necessarily relying on indicator signals to determine your trade entries for you. Make sense? Let's go ahead and spend some time on this idea of convergence that I've been talking about. Convergence between price and the indicators means that both are trending in the same direction and in a similar fashion, making higher highs and higher lows, or the opposite for a downtrend. So if we compare the highs in price along with the highs on the indicators, both should be doing the same thing, making higher highs for an uptrend. Okay? If price is making lower lows, then the indicators should be making lower lows as well. So again, just comparing the swing lows in price with the swing lows on the indicators, both should be doing the same thing for a downtrending chart. Okay, so we're comparing the swing highs and the swing lows of price with the highs and lows on the indicators to then arrive at our determination of this price indicator convergence that we're looking for. And again, convergence, just one more technical tool in our trading box indicating that the trend has a higher probability of continuing than it does reversing. Okay? Now here's an example of that bullish convergence on the chart and what it looks like for you. And as you can see, our price action trend consists of higher highs and higher lows. And I've marked the swing highs on this chart. So you'll also notice the higher highs and higher lows on the indicators that I've labeled, and how those highs and lows correspond directly to the above price action. Now, when both of these are in alignment, like you see it here, the trend is still very strong and it's still very predictable. But notice on the chart that we're only comparing the extreme highs in the uptrend with the extreme highs on the indicators. We're not concerned with the higher lows in this case when we're determining bullish convergence on the indicators. Okay, so we're only concerned in an uptrend with the higher highs and that we're making higher highs on the indicators like you see here. A look at bearish convergence right here. Okay, once again, before determining convergence, we first confirm the price action trend of lower highs and lower lows in this downtrend. And again, we'll just be comparing the extreme lows of the price action with the lows on the indicators to see if they are all in agreement. Now, if everything checks out, then the trend is still intact and has a high probability of continuing in the current direction that we see right here. Okay, so we can use this feature in the trend flow trade as a bonus factor to up the probability of the trade outcome, potentially. And although we can still trade the trend flow strategy with some price indicator divergence, we can't trade the momentum breakout strategy with that same divergence. Okay, if the charts are diverging across time frames, it's best then to back off the breakout trade, since this could possibly signal a false breakout and result in a loss on the trade. So we want to see converging indicators for the momentum breakout trade, just like you see here. That's really important to us, and it's one of the essentials for the momentum breakout strategy. Taking a look at the questions here, Caesar is the first one out of the gate with a question. He says, does this apply to all time frames? Yes, it does. So everything that we're talking about here applies to every single time frame, from a 1-minute chart all the way up to a monthly chart. There's no distinction. So the good thing about that, having a universal trade strategy, is that it applies to any asset class on any time frame. So whether you're an intraday trader or a swing trader, you're still following the exact same strategy, the exact same setup on the chart. The only difference is you're looking at either higher or lower time frames to get that shorter term or longer term trade. Does that make sense to you? And so your next question, Cesar, is which time frames are better to use this strategy on? So I think I just answered that. You want to look across all the time frames, monthly, all the way on down to the 5-minute and the 2-minute, to actually understand what's happening on all the time frames, and then you're looking for the trade setups on any 2 time frames in between all of that. Okay? Now, a couple things to understand about convergence. This chart feature is only valid in a strong trend. Okay, that's really important. So in a ranging market or a sideways market, the indicators act as essentially oscillators, creating those overbought and oversold signals. So we only want to be looking for this type of indicator convergence during a strong trend in the price action. So even a diverging structure, still only valid in a strong trend, right? So if we're looking for our trade setups where both price and indicators are converging, then we're focused on the higher probability trades, and that should be reflected in our win-loss ratio. And if we're looking for trend convergence across multiple time frames, then again, that just adds to our probabilities. So we're comparing the highs in an uptrend and the lows in a downtrend between both price and the indicators to arrive at the conclusion whether the charts are converging or whether they're diverging. Now, for some of you folks out there who may be perfectionists, you don't need to break out the ruler and measure the highs or the lows to the millimeter to see if the indicators are converging, right? And we don't want to really wait and see either to watch price break the level before coming to a decision on that convergence. So it's important to check to the extent that convergence is very close and that the indicators are not diverging. And that's just going to come with some experience from watching price action, but we'll go ahead. We'll take a look at several examples throughout the series to help you guys get off to a running start and really trying to help you understand this idea of predicting convergence, because you really need to do that in order to get the momentum breakout trade right. All right, here's an example of how we can look across multiple time frames to identify convergence. Again, we initially start out with the price action trend by identifying the lower highs and the lower lows on these charts for this downtrend. The moving averages are all in alignment. They're fanning out to the downside. And with every swing low, we can then compare the lows on the indicators to see if both price and the indicators are in alignment and they're continuing to converge with this trend. And as you can see here, the bearish convergence on the indicators confirms the price action trend and the likelihood of a continuation of the downtrend at this point. So on this particular trend flow setup, we not only have all of the essentials to begin stocking this trade, but we also have convergence, which tells us that the trend is still very much at its strongest point, which is great for the trend flow trade. It's almost like a bonus factor. Okay, so we've got price after this rally right back in the sell zone on this downtrend. We're just looking for our setup candle to then get short this trend, and we can continue shorting even until we start to see some slight divergence on the charts. When you get a lot of divergence across multiple time frames, usually you can anticipate that there's going to be a deeper pullback in price. Okay, question here from Dwayne. On price breakout, do you mean above or below the moving average or the exponential moving average? When I'm talking about a breakout, what I'm referring to is specifically the trade strategy, the momentum breakout trade. And that's where price is breaking out of an established flat level. Okay? When we're talking about the trend flow trade, we're looking for a pullback structure. We're looking for a setup candle in the buy or the sell zone in and around that 10-20 period moving average. And so I'll be referring to those in those two ways. So if some of you guys are joining the sessions late, or you might have missed parts 1 and parts 2, you got to go back and get the recording. Make sure you look at parts 1 and parts 2. Every part of this 4-part series is really integral. It's basically a prerequisite for the next course that you take. So if you're missing one thing, then the stuff we're talking about in parts 3 and 4 aren't going to make sense to you if you miss part 2. Okay, so make sure you go back and call customer service, get the recordings, and make sure you go through and study those and prepare for the next week's session. Here's an example of bullish convergence where price is making higher highs and the indicators are following suit. And in this example, you can see that there's a slight question about the convergence on both indicators. Okay, they're basically flat, even though price is making higher highs. This is fine just as long as the indicators are definitely not diverging. You know, if that were the case, then we would see very clear lower highs on the indicators with very clear higher highs in the price action to determine that divergence. So again, I'm just comparing the extremes in price with the extremes in the indicators. Again, both should be in alignment and continuing to make higher highs in this case. The indicators then are just giving us one more ingredient that we can add to the mix to arrive at a high probability trade setup. And these indicators are saying, yes, this trend is very likely to continue in the current direction that it's going. And since this is a trend flow setup right here that we're looking at, it's got to pull back into the moving average zone right here. We actually can take this trade with flat indicators or even some slight divergence, right? So make sure you keep an eye out for these patterns in the coming weeks as you look through your charts for these setups during the week. Another example here to give you just a better idea about convergence and how to predict it before it actually occurs on the chart. And as you can see, price has made a lower low in this downtrend, but the indicators are now making a higher low, and they're starting to begin to trend upward in the direction that's opposite to the price action. Okay, so we have multiple time frames diverging, and we can then anticipate at this point to back off the short trade and more than likely expect a bounce in price. So it doesn't mean the whole trend's going to reverse. It just means that might be a steeper bounce in price, maybe a 50% retracement of the entire move, and then you'll see sellers coming in again to maybe short this market depending on what's happening on the higher time frames. So that doesn't mean that, again, we're trying to call a reversal point right here. We're just recognizing that the chart structure is not as strong as it once was. So the market can still continue to the downside in this case, but we may wish to consider trading, say, a smaller stake at this point. Keep our stops tight, limit our risk. If there's a rally back into the sell zone, then we definitely want to pay attention to the setup candle size. Small candle represents a small capital risk for us, which would be acceptable. If you get a larger bearish candle, that would probably keep me out of the trade, right? Because it means I got to take more risk. The chart structure is not as strong as it once was. And to be honest with you, I know that I can just find a better trade on another day, maybe another market that will give me a better reward to risk and a better confidence level for that trade setup. Now, when we're using the momentum breakout strategy, we are looking for indicator convergence on the breakout to new highs or new lows. So this will be a little different to spot when we're looking for flat levels and convergence, as opposed to the convergence examples that we just looked at, where price was making successive higher highs or lower lows. Okay, so with flat levels leading up to the breakout, we're often going to have to make that prediction about whether convergence is likely to continue on the breakout of the flat level. Since price will not be making higher highs or lower lows in the flat level, right? It can appear sometimes like the indicators are diverging, but upon the breakout of the flat level, the indicators are converging again with price at those new levels. So if you don't understand how to predict this convergence in advance, then you'll end up missing a lot of these momentum breakout trades. So as you scan through your charts, just make sure that you spend some time looking at diverging indicators and chart structures to see how they set up, and then watch to see the corresponding price action and what happens. So let's go ahead. Let's get some practice on an example here, and walk through one of these. So here we have a solid flat level in the price action with 3 touches. Okay, right at this black line that I have to highlight that. The indicators have gone flat on these 3 touches prior to the breakout, which is fine. But price has not established a lower low yet. So the question you have to ask yourself is, if price breaks out to lower lows, will the indicators do the same thing? Because if price breaks out and the indicators are diverging on the break, chances are it may be a false breakout. So we want to ensure that the indicators are converging on the breakout of the flat level. You'll notice for the most part that these indicators will track in line with the price action most of the time, and what they'll do is they'll mimic the highs and the lows on the price chart. So when you get a diverging chart structure, it really should be very obvious to you. There shouldn't be any question about it. So one of the best ways to get more consistent with your chart predictions is to look at higher time frame charts, and that'll help you identify that same flat level, and you'll be able to see if the trend warrants a move in the direction of the breakout. Now, if you find too much trend conflict on the higher time frames, then you may not have a strong enough trend to work with. And what we'll do is we'll go ahead, we'll spend more time on reading multiple time frames a little later on in today's session, and it'll help you guys understand how to read the charts in more detail, okay? Another example here of that breakout convergence. If you notice that the indicators are just slightly turned up as price makes an equal low on that last touch of the flat level, this is where you'll need to predict a continuance of that convergence on the break of this flat level. Okay, if it's just slightly diverging like it is here, then I usually go to the next higher time frame to see if everything is converging there as well. Many times this slight divergence will occur on breakouts when you have many higher time frames all trending in the same direction. So it's a very strong trend. But not a picture-perfect setup right here, but the market will give you these looks often, and you'll need to get good at spotting the setup across multiple time frames. And this type of slight divergence, it will keep you out of a lot of good breakout trades. So you really need to master the strategy setup really right here at this point with this type of indicator setup. The one thing that I mentioned before, if you're managing your risk properly, then that will keep you in the game, especially if the risk is acceptable to you when you see the trade setup. So you can just decide to trade potentially, say half of your normal stake on maybe this less optimal setup. It's still a strong trend, it still fulfills all the essential criteria, but you may be just not as confident with it, and you might just trade a smaller stake on it. And continuing to trade with the trend until it ends can be, just very rewarding mentally, and it also builds a lot of confidence. Since if you go through a lot of missed opportunities, missed trade setups in the price action, that just tends to create a lot of frustration for folks. So make sure you just stay on top of your time frames. Make sure you're reading the charts properly to help predict the duration of the trend. Simple strategies like trading a full stake when the chart setups are optimal, and then trading, say, a half stake or a third stake on, say, a less optimal setup such as this one. Okay, so a good way to bank some additional profits and still manage your risk on a trade-by-trade basis. Now this here is an example of a subpar chart structure from the momentum breakout setup. Okay, and that means we wouldn't be taking the trade. Okay, you can see the flat level in place, and with the most recent touch, the indicators are moving in the opposite direction. Okay, so these are less than ideal conditions for this particular trade setup, and if you can't see the indicators breaking out to new highs along with price, then your best bet is just to let it go, move on to a new chart. Okay, if the overall trend is very strong and you have many of the higher time frames trending in the same direction, then these trade setups will still work, but you need to have the optimal conditions across multiple time frames, higher time frames, that is. So for example, if this was, say, a 1 hour chart, then I would want to see everything above this time frame trending in the same direction and without a lot of overextension from the moving averages on the higher time frames. And what this would do is this would confirm a very strong trend for me, perhaps right after a pullback on the daily chart and the market is marching on to new highs. You can then see these kinds of suboptimal flat levels get broken often, and this will all come, really just with experience and finally mastering that price action. Now, when we talk about indicator divergence, what we're saying is that at this point of divergence, the trend is losing some momentum, and there is a higher probability of a trend change or a pullback or a reversal depending upon what time frame that divergence sets up on. Okay, since we're looking for the highest probability setups with our trade strategies, we want to trade this trend with, as long as the indicators are not diverging, right? This divergence signal then will keep us out of a lot of trades, which is good because it helps us to, weed out those low probability setups that do occur from time to time. So if you find a perfect flat level trade setup, but the indicators will look like they'll diverge on the breakout, then you should avoid taking that trade. Okay, many times on these low probability setups, you can get false breakouts at the flat level, which creates a rejection candle right above that flat level with some solid divergence, and that's usually a pretty good reversal signal or a false breakout signal. So remember, we're only interested in trading the highest probability trade setups, so there's no point in losing our capital on just marginal chart setups, okay? Let's get into some of the details of divergence here so you guys can see the difference in what I'm talking about. So this is what bullish divergence will look like on your charts. Now, as price continues lower in this example, like what we see here on the right, price reaches a point at a lower low while the indicators are clearly making a higher low. And you can see how this mirrors the anatomy example here on the left. Okay, price is still trending lower, but the indicator has made a trend change ahead of price and is now trending upward. And that's why we call this a leading indicator. Okay, so when we get this diverging signal, it actually comes ahead of the move in price, and it signals us to a potential trend change right here. So price will often at this point put in maybe a bottoming structure or some type of reversal pattern to the trend change. So divergence gives us a heads up signal and potentially what to look for in the price action. Divergence is being used here as a leading indicator that is predicting a trend change before it actually occurs on the price chart. So after this divergence sets up, now you can then visualize the price action making its first higher low and then followed by a higher high, which would then signal us to the actual trend change on the chart. Okay, this doesn't mean that we're trading the new trend. It's just signaling to us to stop shorting the downtrend for now because the trend has weakened. So remember, we want to be trading the strongest trends for these trade setups. We don't want to be looking for trend reversal patterns. Reversals are just trying to catch tops and bottoms. There's just no point in doing that. There's no money to be made in trading tops and bottoms. You can make plenty of money just sticking with well-established trends. An example here of bearish divergence. In this chart example, we can clearly see that price is trending up and it puts in a higher high there at the top with some overextension from the moving averages, along with a lower high on the indicators and an overall diverging chart structure. So if we draw a line connecting the highs, then it starts to look something like this, where the red arrows are pointing in the opposite direction, providing a good picture of what this divergence would look like on a chart. Okay, this is a really good example of where we would be trading with the trend higher, and then looking at this opposing signal to then arrive at a point to take our final profit on the trade. Okay, divergence can be just a very good exit signal for your final contract, and it'll often keep you in the trade longer than you may have otherwise anticipated. But even though we're anticipating a pullback or a trend change at this point of divergence, we're still not trading this trend change from the short side. Okay, since we're trading strong trends only, and that's what we're doing with these two strategies. So there's no need to take or trade reversals or pick tops and bottoms, like I mentioned, to make money in the markets. We're just looking to trade with strong trending price action that's easily predictable. That's the point. All right, just looking at the questions here. Josie's got a question. Looking at the MACD, the 12, 26, and 9 settings, which are the lines versus candles? Which are the lines versus the candles? Not sure I understand what you're saying there, Josie. I mean, here we have the MACD, we have the RSI. These are the candlesticks right here for the price action. So all we're doing is we're comparing the higher high here and the higher high here, and we're looking for the indicators to do the same thing. Right now, we have a higher high in price, but we have a lower high on the RSI. We also have a lower high on the MACD. That's the only thing we're utilizing these indicators for. Does that make sense to you? You're looking for the difference between the blue and the yellow line and the green and the red bars. This right here is just a histogram. We don't use that at all. So there's no point in trying to understand the histogram. All it really means is there's a zero line that goes right through this histogram. And what the indicator says is that the market is in a bullish trend, or price is in a bullish trend, when the bars are above the zero line, and price is in a bearish trend when the bars are below the zero line. We don't use this, and we don't use the colored lines either. We don't look at the line crosses. We're only looking for the higher highs and the higher lows, or vice versa, on these indicators to use them as leading indicators. Okay? Yes, the settings are 12, 26, and 9. I believe that's the setting. It's a standard setting as it is out of the box. Correct. So here's an otherwise optimal chart structure with higher highs and higher lows, but the indicators have rolled over and they're beginning to trend to the opposing side. So again, not an attractive trade. For the breakout setup right here, if we're to consider the trend flow trade right here, we would continue to trade this trend until we get a lower high and a lower low in the price action. Okay, so in the meantime, during a strong trend across all the time frames, high to low, you can see this kind of divergence often in the markets, and the market will continue to diverge going in the direction of the predominant trend until it makes another higher high or a lower low and reaches a significant level of support or resistance, and then you'll see the pullback on those higher time frames. Okay, so the best way to identify this is on the highest time frame, like the weekly and the daily charts. Gives you kind of an overall sense for when another pullback structure will occur on these higher time frames. And that's why trading with the trend is always going to be your safest entry into the markets. When you get these pullback structures on those higher time frames, the market is really set up to run for a while, going in the direction of that predominant trend. So between the two trade strategies that you're learning here, you have the tools necessary to trade the complete trend structure from beginning to end. Does that make sense to you? Take a question here. Michael's asking, on the MACD indicator, which line are we looking at for divergence? It really doesn't matter. You're not looking for the blue line or the yellow line, because as you can see, they usually end up crossing somewhere around these levels. So on this particular one, you're going to be looking at you're just going to be looking at the higher highs made here. There's really when I look at it, I really don't see any distinction as to whether it's a blue line or a yellow line. because when you get these diverging levels, usually the lines are going to be pretty close together. Okay, so don't worry about the difference in lines. You just take the higher line that's there if you're looking for bearish divergence like on this chart, and if you're looking for bullish divergence on the opposing side, just take the lowest lines and look for higher lows. That's going to signal to us that the charts are diverging. Here we're looking at another diverging structure, a great overall trend in terms of the price action with another lower low and some good solid divergence on both indicators. Okay, sometimes you'll see divergence on just one of the indicators, and that's usually marginal. Many times you can trade through that setup. But when divergence is on both of the indicators on the same chart and you have divergence across multiple time frames, then it's really time to pay attention because the trend is most likely weakening at this point and you're set up for a deeper pullback. Okay, you'll notice these reversal structures in place when divergence occurs also. Bottoming structures like head and shoulders patterns, double tops, double bottoms are common as well. And in this case, it's a double bottom structure right here, if you can see that. And if the market puts in a new high above this most recent lower high, then the trend change will most likely be a larger reversal pattern or some kind of retracement of the complete downtrend move right here. So again, this is dependent on the higher time frames above this chart that we're looking at right here. Okay, so diverging structure, double bottom. What the market does is it usually breaks above this level and then does a mirror image to the top side. Or if we did a Fibonacci retracement from high to low, we'd probably find it'd be like a 50% retracement before the sellers came back into the market. So you allow the divergence to play out. Usually it plays out into that 50, 62% Fib retracement zone, and that's where the next sell-off comes. Okay? We'll just walk through two more of these charts here. Just want to show you the different looks the market will give you on these strategy setups so you can avoid some of the obvious mistakes right out of the gate. Being able to identify the higher probability structures, it's going to take some time as you begin to master price action analysis, but this is absolutely going to be key to being consistent and building confidence with these trade strategies. So by looking at this chart, would you guys trade this breakout setup? So this is, again, part of the a little bit of homework for you guys. This is where I get quiet and turn off the microphone, and you guys study the chart for yourself, start to apply what you've been learning here. And what I'd like you to do is just use the question box on your screen, send over your answers via the question box, and I'll just turn off the microphone here for a minute or so, give you guys a chance to think and get your responses over to me. Okay, and both questions are right there on the screen for you. All right, so I'm just looking at some of your responses across here. I see a lot of you guys are saying no trading, not taking this trade. There's bullish divergence. It's pretty consistent for all you guys. Okay, let's just walk through this one together. The first consideration when looking at this chart is to look at the first lower low and then identify any divergence that may exist. Okay, so as you can see, the divergence occurs at the first lower low, okay, and then begins to trend upward from there with each subsequent equal touch at this flat level. So at this point in the trade setup, we have 4 touches at the level. Okay, both indicators are rising with each and every touch of this level. That's not what we want to see for the momentum breakout trade, and you don't want to wait and see to determine if the break converges or diverges. Okay, you need to make that decision ahead of time prior to the break at this flat level. So I mentioned this before. The only other thing to do here would be to look at the next higher time frame to see if there's a breakout trade on alternate time frames where divergence may not be present. Okay, but you still need to make sure that there is a valid flat level on those other time frames and that the trade setup is still intact. So if we're getting divergence here, as opposed to saying, hey, it's a no trade, but it's a no trade on this time frame, let's go to the next higher time frame, and maybe we're just too low in the time frames to identify the correct structure that we want. So if you move up 1 or 2 time frames, you might possibly identify that on another 2 side-by-side time frames. And if you find that a lot of charts are confirming the trend, usually you'll start to see that setup and gain some confidence by seeing that across multiple time frames. Okay. Let me look at the questions here real quick. Murtaza's asking if the RSI and MACD is still pointing upwards with the break trade. Okay, you're still responding to this one. Let's see. I think some of you guys are. Okay, so you guys are still sending me over your responses. That's cool. Okay. All right, so one more exercise here on this chart. Give you guys another opportunity. Can you determine if this chart is converging or if it's diverging? I'll give you a minute. Go ahead, send me over your answers. All right, so just looking at your responses here, we've got diverging, diverging, converging, diverging, diverging, diverging. Okay, so most folks are in the divergence camp. Let's just go through this one together. Some of the annotations here that you can see. This one's a little more complicated. Okay, so we're trying to trip you up here a little bit, and that's what the market will do to you. So we'll start with the first lower low where we identified the old divergence. As you can see from this low to the next lower low, right here to here, the indicators begin to, or actually it's from here to here, the indicators begin to start to trend upwards. Okay, and then you'll get that old divergence playing out with this rally right back up into the sell zone. Okay, so we got old divergence. We basically have 3 divergence bumps here to here. Gives us that first higher low on the indicator. I mean, we actually almost had a higher low back here. We didn't have it on the RSI though, so we're not counting it. We're looking at where both indicators are first diverging. Okay, and then we got to move back down to another low, a new low, where the indicators are either flat or they're potentially, arguably converging again to the downside, because we again have from a higher low, we now have a new lower low. Not necessarily, it's pretty close on the RSI, but it's a little bit more obvious on the MACD. So what we're doing here is we're comparing the most recent low with the current low to determine that convergence on the MACD. Okay, the RSI is either flat or slightly rising, slightly diverging. Either way, this is a strong trend to the downside. The price action trend confirms a lower low, and now we can anticipate a bearish candle in the sell zone and a lower high. But we won't know until we actually get that candle set up, right? But it appears that the market's heading lower for right now. So we really need to see the higher time frames here that will tell the story based on this chart. The higher time frames are most likely confirming this trend. Okay, with this type of divergence, normally the market would bounce up, but it's really kind of a dead cat bounce. Big bearish candle in the sell zone, and the market just rolls over again. That means that there are probably a lot of higher time frame charts that are rolled over. All right, so working with multiple time frames gives us additional confirmation since we are looking at the same price action represented in 2 or more time frames, which provides us just another view into what may be happening in the markets. So let's see, we're going to start a new section here. It's about 9 minutes before the top of the hour. Why don't we take a break right here? I've got to refresh my water glass and rest my voice for a few minutes. So let me put up this this timer here. We'll get this thing going. Let me see. Set it up for. Still didn't figure out how to work this thing, guys. Sorry, I can't seem to get it at 9 minutes. Let's see, edit options. Anyway, we'll start in about 9 minutes at the top of the hour, and I'll fool around, try to get this thing working here, okay? All right, we'll see in about 9 minutes, and we'll kick off the multiple time frames section. And I forgot to show it to you. Sorry about that. Everybody better? Okay. All right, so again, really just checking the higher time frames to see that we're just looking for those higher time frames to see where some of these levels of support and resistance, and that's going to give us a pretty good sense for the strategy setups and where we should be stocking a trade and looking for those trade setups around those key levels of support and resistance, such as the momentum breakout trade, for example. So again, this table just giving you an example of looking to the next higher time frame, whatever that may be in the setup, in order to get the confirmation of that trend, to get the support or resistance levels, or in getting that convergence or divergence of a trend. So oftentimes when you look across multiple time frames, you'll see different strategy setups on different charts, but they'll all be confirming the same direction, provided that you have a good strong trend across multiple time frames. Okay. All right, one of the main reasons that we use multiple time frames on these trade setups is because the trends can form on any time frame, and they sometimes do contradict each other. Okay, so what this does is this helps us in identifying false trade signals, and this will help to keep us out of some bad trades. So a bad trade really just simply another term for a weak trend, right? So contradicting information on multiple time frames just signals us that the trend is not as strong as we need it to be for these trade strategies. And we need to be trading strong trends in order to utilize these strategies that we're talking about here in this series. Okay, new traders or inexperienced traders often make the mistake of trading from a single time frame. The analogy here, it's kind of like driving through thick fog and the view of the road is obscured, right? Which places your journey more at risk. And I know personally that if I'm not looking across many time frames, I just really feel like I'm flying blind, and I have no idea where the price action's headed next. So once you get used to scanning your time frames properly, you'll never look back. In comparison, it's kind of like driving on a very clear day where you can see the road for miles ahead. And then you can clearly see any obstacles that may be in your way, and that just gives you a heads up to potentially avoid that conflict. Okay, so that's what we want to be doing in trading. So what this means to us then is that we are constantly trading with both short-term and long-term trend agreement, and this is what improves our overall probability of success on these trades. So looking at the same trend in another time frame, okay, this is really just another ingredient, as we've been talking about, right, or another technical factor, if you will. This helps to improve the probability of successful trading outcome for us. So it provides us with additional information and possibly a bigger picture view as to what may be a longer term move in the market. Okay, a trade set up on a 60 and 120 minute chart is going to have a longer trade duration than, say, a 2 and a 5 minute chart. But even when we're trading the higher time frames, we can still utilize and time our entry with those lower level charts to get as precise as we can with the trade entry. But if you're struggling with how to stay in a trade, okay, understanding multiple time frames is really going to be the answer for you. Additional evidence and additional technical factors can only help trade probability. Okay, so it just makes logical sense then if we identify a trade setup on the 60 and 120 minute time frames to also check the 240 and the daily chart. And if we find that a higher time frame confirms the setup on the lower time frames, now we just have 3 charts confirming that move. Okay, the higher time frame providing us with the bigger picture view as to what's really going on, And on the higher time frames, we'll also notice those key levels of support and resistance that will provide us some good clues as to the levels we either should be buying or selling at when we find a trade setup that meets our criteria. So this will just translate to better stop loss protection and better target identification. Good example would be placing your stops protected by major levels of support and resistance that you've identified on the higher time frame, or placing your profit targets just ahead of those major support and resistance levels. So higher time frames, they can really help us to optimize our trading setups and our parameters. All right, so let's see what we can find in the charts right here. All three time frames are in agreement and they're uptrending. So what I'd like you guys to do, another homework assignment here, go ahead, take a look at these three charts and see what else you can determine from the price action alone. Okay, so I want you to think it over. Go ahead, send me your responses via the question box, and I'll give you a hint right here. What I'm looking for is on the daily and the 480 charts. So try to apply what we've been talking about, and I'll just be quiet for a minute and look for your responses. All right, so just looking through some of your guys' responses here, looking at your analysis. So some folks are looking at possibly a tired trend. Some folks want to see the lower time frames. That's always smart, looking across a wide spectrum of charts. Some folks are saying, hey, we missed the buy zone on some of these time frames. Let's go ahead and walk through this one together, and see if there's anything here across these time frames that can help us to get a better understanding of price. Is really what we're driving at. So just beginning from the top down at the weekly time frame, we can see that price is overextended from the buy zone by quite a large margin here. Okay, so it's been a nice run up. We have big candles, big sell-off at the top. And just looking back historically, that overextension has resulted in pullbacks to at least the 10-period moving average, right? On the daily chart, looks like we just had that pullback to that 10-20 period zone. Okay, price is now accelerated higher again out of that zone. So each time it has done this in the past, it's moved up to either an equal high or a higher high in the price action. So the 480 chart, the 8-hour, nice pullback structure right back into the zone. It's taken off again, it's moving higher, more than likely back to at least at a minimum the swing high level, if not to a brand new higher high. So if you find a trade setup on the lower time frame, do these charts help you to get a directional bias and also provide enough price information to potentially keep you in a trade longer? Okay, so absolutely, when price pulls back on these trends, they tend to accelerate rapidly out of the buy zone, like you can see here on these two charts, until you start to see divergence then on the 8-hour, the 4-hour, the 2-hour charts. This right here, is just a very, very strong trend right here. So even though we might have missed the entry right here, if you go down to a smaller time frame, you'll start to see pullbacks on the smaller time frames, maybe the 60-minute, 30-minute, the 15 and the 5-minute definitely. Because more than likely this is going to trend all the way up to this level. But since price has already moved, we're not taking this trade on these time frames where it's set up on, but we are using these time frames to get the higher level directional move that we're going to be trading on the lower time frames. Okay, but the chart setups are going to be identical even when we go to those lower time frames. So as the 480 daily and weekly are all in strong uptrends, it's likely that the 60-minute trend will mirror the long-term trend eventually, but shorter-term traders would likely wait for the scenario to occur and get the chart trend in alignment with the higher time frame. Okay, so what would you guys do in this situation with this time frame right here, looking at the 60 minutes? Same trade, we're just going down a couple of time frames from that 8-hour chart down to the 1 hour. So think about it. Go ahead, send me over your answers, and I'll just be quiet, wait for you for a minute. All right, so looking at some of your responses here, some folks are saying the 60-minute chart gives me a little bit more precision on my entry, since there was no entry point defined in the price action on the 8-hour and the daily chart, so that's accurate. Some folks are saying, hey, this is a no trade. Another person saying, hey, I'd be waiting for a nice small bullish candle to set up on the 60-minute chart, really, right? So you'd be looking for the trend flow trade. Good, let's walk through this one real quick. So all those 60-minute trend right here is in a potential trend change to the downside, right? Because we have actually a lower high right here and a lower low, technically. By looking at the higher time frame trend, this should actually discourage us from shorting this chart, right? The probabilities are high that this pullback into the buy zone, which is happening right here, is going to generate more buying. Now, if we check the 120 and the 240-minute charts, which would be ideal for this trade, so everything between the 8-hour and the 1 hour, that would probably tell us what's really going on in terms of really completing the picture for us here. So those time frames will most likely have a pullback structure setting up for another long trade right back into the buy zone, potentially on the 120 and the 240. So the easy answer here is looking at the missing time frames between the 480, the 8-hour, and the 1 hour charts in order to fill in the gaps and then complete the picture for us. But for right here, just looking at those higher time frames, looking for that pullback structure right here, that would give me enough information to go ahead and get long on the first bullish candle in the buy zone here on the 60-minute chart. But just as a natural habit for me, I'd be looking across all the time frames and getting myself just a better picture of really what's going on with price. Okay, so let's roll through a series of these chart examples and give you guys some supervised screen time at reading the charts. Go ahead, take a look at the question box on the screen. Go ahead, send me over your answers for the 2 questions here. Is this an acceptable time to buy right here? And what else would you like to see, on these 2 time frames? And so I'll just be quiet for a minute, give you guys a chance to send over your answers, and I'll just wait to see those. All right, so just looking at your responses here. Okay, everybody's on board with this setup. Good pullback in the buy zone, setup candle. Some folks are looking at the RSI and the MACD, seeing if they have, but there aren't any MACD and RSI here. They're saying they'd like to see that, see if there's confirmation of convergence. Okay, that's good. Some people are saying indicator convergence needed, not on the trend flow trade. So if it was a flat level break, the momentum breakout, we would need to be able to predict convergence. But right here, I'd still be checking the indicators to see if there's any serious divergence, because we got a couple of new highs here. So there's a possibility the indicators could be diverging, but we just don't know that because we don't have that on the chart structure. So we're really just trading off of pure price action here. But in any chart setup, like right here, I'd definitely go down, take a look at the indicators to see if they're still converging or diverging. But even if we do have some slight divergence with this most recent high, we can still take this pullback and still trade the trend flow going in the direction of the trend with some slight indicator divergence. We just can't do it with the momentum breakout trade, okay? All right, so taking another look at this one with the flat level right here. Do you guys think this flat level is worth trading? What other information would you like to see before making up your mind? Go ahead, send me over your answers, and I'll wait to see those from you. Okay, so I think you guys are catching on to what we're doing here. Some folks are saying, hey, no trade, I need a confirmation chart. Other folks are saying, hey, where's P1? Not worth risk capital, need another time frame. Want to check the MACD and the RSI. Okay, so good. So you guys are spotting the information that you need, but you don't have. Okay, so let's walk over this together. The flat level is not ideal on this one. A lot of you folks didn't really give me clarification on the flat level and what you thought about it. But you did give me some things that, hey, even there's no point in me considering the flat level if I first don't have the MACD and the RSI and I don't have a couple of time frames. And that's fair enough. So, okay, there have been 2 false breakouts on this flat level. This is kind of a deeper dive here into really fine-tuning a flat level. And so a couple of false breakouts here. The level is not perfect, although it's still pretty good. It's still pretty flat. But since we have higher lows trending up into this flat level, it almost makes it worth some consideration. We got a swing low down here. We have a higher low here, another higher low here, smaller candles consolidating up into this flat level. And with each one of these rejection candles, we did get a relatively solid pullback that created a higher low. So even though we got another rejection candle here, it looks like we're still getting another higher low, which is a very positive sign. So in order to consider this trade, we would need to see a great trend on not only this time frame P, but also P1 and even possibly P2. Okay, we need to see the indicators showing convergence and likely convergence on the break of the flat level. Okay, no support and resistance en route to the target. This would be visible then on the higher time frames, P1 and P2, and then also price not significantly overextended on P1 or P2, the next 2 higher time frames. Okay, so a couple different ways there to identify and read, the overall price action in these flat levels. So just because we go along here and say, okay, 1, 2, 3, potentially a 4th touch, let's look at some of the candles there on these pullbacks. Okay, nice rejection candles, got a pullback off of there. Nice. Sometimes if we get a solid breakout above here and a big rejection candle, that means that the market's going to reject this entire level and potentially move down beyond the swing low. And that usually happens on some of the higher time frames. But some of these smaller little breakthroughs and then rejections usually mean we're going to get just another pullback and another higher low. But we don't have to make a decision about taking the break at that point because we're just looking for some lower highs. At this point, the second touch, we don't really have a trend structure. We have 2 touches, but we don't have higher lows trending up into this flat level, which is really an optimal chart structure that we want to see. Let me take a look at some of the questions here. Dimitri is asking, do you consider a breakout even if price didn't close above? Yeah, absolutely, because what we're looking at right here, we're looking at just a touch of a common resistance level. And so all we're getting here is a touch of that level. And since we want to see a pullback off that level to get another touch, we actually do want a rejection. But we don't really want to see a lot of large rejection candles. I wouldn't want this to be a rejection all the way down to here with a close. This is fairly, it opened here, it closed here, the candle's still bullish. So we still want bullish candles moving up into these levels. We don't want to see a lot of long shadows, a lot of long tails coming off that level. That's just not a good sign. That's not a good flat level setup. But as you can see, we have a number of smaller candles that are trending up into these flat levels. A touch there, finally get another touch, a pullback off of that. That's just all reasonable stuff. Seeing a couple of candles kind of court that flat level right there is pretty ideal for us. So here's the next two higher time frames from that same chart that we just looked at. Just kind of look through these two charts and send over your answers as to whether this is the right time frame to get long this trend. Okay, so I'll just wait for you guys. Send me over your answers and let me know what you're thinking. All right, looking at your responses here, some folks are saying no trade, price is too far from the moving averages. Okay, so we didn't have a good look at the flat level, and just going over a couple of more time frames. Nice trend here, nice confirmation of that trend, but we don't really have a setup in the price action. Some folks are saying not the right time frame. That's a good eye. That's definitely a possibility. And one of the ways to identify that it's not the right time frame, or we've clipped maybe two higher time frames from the one that we were looking at, is because the candles, there's no flat level here really. The candles are all very close together, which means each one of these candles is maybe, I don't know, maybe a 15-minute or an hour or whatever it is. But on the other one, we had a very long consolidation of multiple touches where we don't have that here. So what we want to do is from the last chart, we want to go up to the next higher time frame and make that P1, and then look at the next higher time frame. So we're trying to throw you some kind of throwing you a curve here to make sure that you guys understand how to, when you're looking at one chart, you pretty much almost know what the next higher time frame should sort of look like. And then when you get there, you got a pretty good idea. Yeah, that's what I thought it was going to look like. And then sometimes, two or three higher time frames you really don't know, but you can just pull those up and then take a look at those to see what the deal is. But let's walk through this one together. Price is overextended on P1 and P2. So we got overextension price from the moving averages. That does not signal to us an entry point. Price is also very near the swing high, which is the resistance level, so that's not good. So price could possibly go higher if this is a strong trend, but the probabilities are just not high enough for us, right? We want really high probabilities for these trade setups. Now, since we're reading the price action here, the flat level could have a deeper pullback, and then it could rally to break the flat level, and that would get us back into the buy zone on P1 and P2. So I would continue to stock this trade setup to see if the moving averages catch up to the price. And at that point, you'd have price in the buy zone, at this resistance level, a sort of combination breakout trend flow trade setup. But as it stands right now, the trade is a no-go. You'll find better trade setups than these. Just make it a point of looking through your charts. But again, I would check some of the closer time frames in between P and P1, because I think we jumped up here a couple of time frames on you to give you a different look and kind of test your knowledge. Just a quick test here on these two time frames. How many trend flow setup candles can you find in the buy zone on these two charts? So just kind of walk through these yourself and kind of eyeball it, compare both chart structures to find the setup candles on both P and P1. And send me over your answers. Just send me a number on how many you found all together. How many good trend flow setups did you find on both charts? Just run through it real quick and just count those candles and shoot me over a quick question box number, and I'll just wait for you. All right, some folks are saying 10. Some folks are counting 12. Some folks are counting 3. Okay, so let me kind of just kind of walk through this together and show you guys what I'm looking for here. This has been really just a generally a well-behaved trend on both time frames. So just a great looking trend to trade. I love the price action here. I'll trade this all day long. Good chart structure here, steady trend, consistent buying pressure, nice small candles throughout the trend if you can see that. That is just really a prized trend when you get those nice small candles. Very consistent. Price doesn't move really fast, but it just continues to trend in the direction that you want. Nicely fanning, moving averages going in they're in the correct order. They're going in the direction of the predominant trend. There are many places where opportunities had set up for this trend flow strategy. So this gives you a pretty good idea that when you find trends like this, you can trade them for a while. So that little counting exercise, just going through and saying, wow, this trade setup is setting up time and time again. This thing's going to keep going. So the last candle on this chart is a little larger candle, okay, than any of the prior candles, and it shows basically an imbalance between supply and demand for this asset class. Although the price is moving rapidly, this is definitely not the time to buy, as larger candles potentially signify that the move has already happened and price is now ready on the overextension from the moving averages. It's ready for a snapback into the moving averages to create then that next bullish setup candle. So the price is likely to again revert back to the buy zone at this point, since we have that overextension from the buy zone. But in looking through these charts and looking for the number, we've got 1, we've got 2, 3, 4, 5, 6, 7, 8, 9, 10. Now some of these other ones are in here like this. Definitely valid, and once you get some of that overextension, sometimes you get this. You get a little sideways consolidation, and the market comes in. It comes a little lower than that. So if you don't make sure at getting the trade to break even, then the market can pull back and not necessarily invalidate the higher highs and higher lows of this trend setup, but you can get stopped out on something like that. Now I don't have. It might be an equal touch. I can't really tell from here, but it might have just slipped just a tick or a couple of pips below that. But what we're trying to do is get the trade to break even, basically right here. So if right here we have a break-even trade, we can potentially be taking some additional profit here. And even if this does roll over and stop out some of our later contracts, not a problem. We're at break-even. We've made a little bit of money, maybe at least. And then we're back in the buy zone, looking for another bullish setup candle, and we're looking to do the same thing all over again. Get that trade to break even right about here, and then if you want to let it run and risk getting stopped out, just let it run. And what markets do is they make higher highs and higher lows. That's what they do. This is really kind of a little bit of an aberration here that occurs sometimes, but it really doesn't occur a lot. The probabilities are definitely in your favor to potentially hold for a longer term run. So this is a great example of a downtrending chart structure showing the succession of lower highs and lower lows, and then the trend changes within this trend, as you can see. So a lot of amateurs look at charts like this and they think that they can trade them from both directions. So I guess you could, but you just have to consider that the moves going with the predominant downtrend, they're just so much more powerful than any of the counter trend moves that you might consider. Okay, so typically when you're trading with the trend, you just get far fewer pullbacks that tend to shake you out of trades or that have a tendency to stop you out. When you're going with the trend, you can see that you just get solid moves to the downside, and the market really runs for a long time. On the uptrend, it's kind of like an escalator, And if you're trying to trail your stop up, you're just constantly being tested and tested and tested, where on the downtrends, you're not being tested at all. It's just a free fall. The market's just falling off a cliff, and you're going along for the ride. Okay, so that's why you want to trade these trends from a single direction. It does a couple of things for you. It creates a very positive mindset to trade from. You get in the habit of holding on to your positions longer and really riding the trend strength. I've seen a lot of folks, trading the short counter trend moves, and it's just, it just gets you jumpy. It's just not very enjoyable. It's a bumpy ride. Going with the momentum just tends to be more of a relaxing trade. The trade typically has a much longer duration, so you just have far fewer trades that you make for potentially far more profit, and that's kind of the idea in trading, right? So this is the power of both short and long-term trends in alignment and going with that higher time frame trend. So let's go ahead and piece it all together like a recipe, and we'll do some complete trade examples so you guys can see how all this works together. These trade examples will be class participation exercises on some of these. Some of these I'll just go in and review. But I want to get you guys thinking about these setups and getting you comfortable combining the technical factors to begin building a trade idea. So let's get started here by describing the trade setups that you see here, and we'll look at this one in hindsight because I want to point out some examples here. First, look for the momentum breakouts, and then I want you to look for the trend flow trade with that small bearish candle in the sell zone. Okay, so I'll give you guys a minute to do this. No need to send me over your answers or anything like that. Just I want you to make some notes to yourself, make some mental notes if you want, and then just in 30 seconds here, we'll go and we'll review the trade together. But again, look through this trend and look for the momentum breakout, flat levels, going in the direction of the trend, and I want you to look for the trend flow trades, okay? All right, so I'm sure you guys are getting a little better at this and getting faster at it, so let me just show you some of these. Let's identify the momentum breakouts. You should have come up with 3 of them. Pretty easy, right? They were all fairly obvious to you in the price action. And look at the nice predictable moves that you get off of these breakout patterns. Okay, the first one was pretty good setup with converging indicators right down here. Okay, the second one might have looked like it was slightly diverging, but the indicators were just following the price action. The price action was at a higher level, and so were the indicators reflecting that. And finally, when it broke through the level, you could see the divergence with the higher low in place right here. So that's the first point of divergence with that first higher low in place. And then another flat level break, and the indicators are definitely diverging on the break here, but price continues to fall, and the indicators are once again converging to the downside, placing in a new low beyond this previous low. So we're again converging from this low to that low. So you really have to pay attention here and get very detailed on what's happening with the convergence and the divergence, because it can change quickly on you in a strong trend. So when you see charts like this, you want to be able to switch over to potentially another strategy when the setup doesn't necessarily warrant a trade. Like in this case right here, we've got divergence. We can't take the break of the flat level. Okay, so we could have switched over and looked for trend flow opportunities instead of the flat level break. Since you can continue to trade the trend flow with some divergence on the charts, you just want to be aware of what you're doing, right? So there were 5 trend flow setup candles in this chart, just ahead of the breakout levels, except for even this last one, we had a nice trend flow candle set up right there. Once we took the break of the low of that candle, we had a nice fall off. There was even a nice setup candle right there that kind of initiated the flat level. So sometimes they're not always as clean. Sometimes you do get a longer consolidation. But even here, you have some divergence on the charts with this low. So when you're taking this one, you're taking it with divergence. And I would prefer probably a smaller candle, maybe even a consolidation of small candles before jumping back into this trend going short because of this divergence right here. Okay? All right, so let's do one from start to finish. You've got 3 time frames to work with right here. What's good about this trade? Go ahead, send me over your answers if you would. I want to make sure that you guys are all understanding the multiple time frame concept and how to read the time frames correctly. So just send me over. It's kind of a one-liner via the question box, and let me know what's good about this trade and why you would want to trade it. Okay? All right, just looking at your responses here. Overextension is taken care of on P. Yeah, it went back up, did an equal touch, a third touch at that resistance level right there, pulling back into the moving averages. Moving averages aren't, they are still in, they're not really in alignment on P, but they are in a little better alignment on P1, definitely in alignment on P2. Some folks are saying it's a sideways consolidation. RSI and the MACD are pointing down, so there's a no trade in weight. I'm assuming that you're talking about divergence on P, which is accurate from these three touches. We don't have higher highs here, but I think if you actually looked at it, we might have slightly lower highs here, but I think these two are pretty close. But we do have maybe the flat structure or maybe just a slightly diverging RSI in this case. Some folks are saying P2 not overextended, RSI and the MACD are in the correct direction. I would tend to agree with that, and the reason I would agree with that is because I'm looking at the higher time frame, which is in a very strong trend. Let's walk through this one together, make sure you guys don't get faked out of these. P2 shows a good long-term trend on the highest time frame. So you'll notice I'm doing something very different from what you guys were doing. You guys were reading from left to right because that's normally the way we're taught to read, right? But in this particular case, what I'm just doing is looking at the highest time frame all the way on down. So I'm reading this chart from right to left. So obviously, if you were setting up your charts like I set up mine, I set up the highest time frames to the left and read naturally from left to right. So I'm just always reading naturally the way I do, in the way we do in the English language, looking at the higher time frames, because this tells me really what direction I want to go, and I'm basically looking for pullbacks into the buy zone, or I'm going down to lower time frames and looking for those pullbacks into the buy zone. Because when you get on these higher time frames, they can stay overextended for a long period of time. That doesn't mean I'm waiting for this trade right here. I can be down here looking for, 2 or 3 time frames lower and finding great trade setups moving all the way up into these levels. Okay, so there is a flat level with 3 touches as we move down to the lower time frames. I wish I could identify how close that is by putting a line in there, but I can't really at that point. But let's just say it's a flat level. It's fairly close, fairly precise. Price is not overextended on P or P1. Okay, price is almost right in the moving average zone, which is actually a bonus for the momentum breakout trade. The MACD indicator is flat to converging on P. P1 is showing some slight MACD convergence, but the P1 RSI is flat and P2 is converging. And so the charts are more convergent, essentially, than they are divergent across these 3 time frames. So that's how you kind of look at that across time frames. We could probably even look at P3. We'd probably even find another trend on the higher time frame. So again, price is forming, higher lows, trending up into the flat level. As we can see here, we have this big pullback. That's the swing low. And then we put in another higher low, and then another higher low, another higher low. And then if this turns out to be a higher low, we'll end up probably getting a consolidation at this level before the break. And that'll be the final determination of whether this is going to be a good breakout setup for us. But overall, right now, it's looking for a pretty good trade to stock. I like having the 3 time frames. That gives me a lot of visibility going forward. But we're still looking for a move back up to this level. I'd be looking for a potential consolidation at small candles at that level, and looking to move higher. But essentially, higher time frames look great, and I'd be definitely looking for a trade long on this trend. Here's the last one. Let's just walk through this one together real quick. Let's see what we can find here. Okay, what's good about this trade? So first off, we can't see much of the trend on P and P1, right? But we assume for this example that the trends are good from at least what's visible here. So this was just kind of a screen real estate issue, if you will, because we're on some lower time frames here. The flat level is forming and has already been tested 3 or 4 times on P. This chart right here. The flat level is forming at a big round number, okay, right in around that 8,500 level. Moving averages are fanning out in order on P1, which is good. Indicators are slightly divergent on P, and that's the reason for concern on the precision chart, right? Because that's essentially our trade entry chart. So what I would like to see here would be a consolidation of small candles pressing down on this flat level. Okay, So also I would like to take a look at the next higher time frame to check the trend confirmation, see how strong this trend is across multiple time frames. Those two additional criteria would effectively get me into the trade. But since I could possibly move the trade up one time frame and eliminate this divergence and trade essentially from P1 and P2, which I would relabel to basically P and P1 if that were the case, and that would then eliminate this chart structure, and I'd be trading with a higher time frame trend. So another positive here is that the moving averages are catching up to the price, which is very good. When you see that, you know that moving averages are putting pressure on price going in the direction of the downtrend here. So a very good indication that a breakout is potentially imminent here. With all of our other technical factors, I'd go ahead and check support and resistance levels on some of the higher time frames to see if there's anything in the way of potential target down around this level. All right, so today you guys learned a few more technical ingredients that will potentially increase the probability of success with these trade setups. Remember, though, that the ingredients alone are not enough. You need the trade strategy, okay, the recipe to combine those ingredients together, right? So we talked way back when about baking that chocolate cake, if you guys remember. Okay, is baking an art or is it a science? And how about finding good trades? Is that an art or a science? Well, it's kind of a little bit of both, right? It's a combination of the two that really makes it work together. Okay, so in order to succeed, we'll try to make it as scientific as possible, so that way we can repeat it over and over again in the markets with more predictable results. Now, just like with anything else that you do in life, there's always the odd exception to the rule, right? So just keep an open mind as we move through these concepts. But before we get into the strategy, let's talk a bit about money management, since that is a part of any trade strategy. And then we'll go dive a little deeper next week to show you proper money management and then exactly how to do that. I've talked a bit about risk and money management, so let's spend a little bit more time on this since it truly is one of the key concepts of trading, and a lot of people just don't do it very well. Okay, most often amateurs they're just too focused on the potential reward or the potential profit of a trade. Okay, they're focused on how much money they can make from every trade instead of considering how much they could potentially lose. Okay, so a few common questions that new traders ask are, where and when do I take profit? Once I get into a trade, I haven't got a clue. Why get out of the trade when I could have stayed in and made more money? Or, why take profit at 1-to-1 reward to risk when I could have gotten 3-to-1 or even 4-to-1? So it's important to focus our attention in slightly different areas in order to change our actions in the market when we're trading. Okay, the more experience we gain as traders, the more likely we are to treat trading as a business. This experience extends itself to an overall focus on risk. So in other words, focus on how much a trade could potentially cost you, and then figure out how to place limits on that downside risk as your primary objective. So if we're too focused on profit, then we miss this concept and find ourselves chasing trades of lesser quality or just not following our trading plan or our trading strategy. Okay, it's also going to be prudent to note here that trading the Forex markets does have associated risk, okay, namely the leverage involved and the volatility in markets. Simply means that you can make money or you can lose money very, very quickly, okay? All right, so as traders, we are constantly exposing ourselves to manageable risk, right? The key word there being manageable. And that is the risk of losing our capital. And we have to accept this as traders because that's just part of what we do. It's part of the deal, right? We continue to do this because there's a payoff that's potentially greater than the risk that we're taking. So we risk our capital for the potential to make the same or more than what we risk. And this is the reward for assuming that risk. Now, many people that you trade the markets, they seem to miss this concept, but risk is an extremely important part of our trading. And it's important because it's the one thing in trading that truly is manageable. If you're constantly taking unlimited risks in the market for limited profits, then that's just not a good business scenario. Okay, so the trading risk model has basically 4 options to it. Okay, the first being to transfer the risk, simply meaning that you invest your capital in an automated system or an investment vehicle, which is most often out of your direct control. Okay, the second option is to avoid the risk completely, or in other words, don't trade or have no risk of loss or have the risk of loss completely eliminated. The third and fourth options are what experienced traders usually apply in their trading. And what we do is we accept that there is a risk present when trading, and we take steps to reduce its overall effect on our bottom line or on each and every trade. Keeping in mind that there's always the potential for you to lose all of your deposited funds if you choose not to actively manage your risk when you're trading. So the responsibility that we have as traders is to manage risk and ensure that the potential sum of our winning trades is greater than the sum of our losing trades. Because you could effectively only be right 50% of the time, but by utilizing proper risk management, you could actually be profitable at only being right half the time. So we'll be spending more time on this topic in part 4 next week. So why do we need to manage our money, might be the question. Well, trading can be described as the game of survival for all new traders, okay, especially when you're learning a new way to trade, a new trading strategy. If a new trader wants to reach their goal of becoming a seasoned operator, potentially making a return from the markets, then it's advisable to implement some kind of money management strategy. Okay, money management is the application of a set of principles to a trading business, and there is but one goal of a trader's money management system, and that is to reduce the impact of trade risk to our bottom line. And in other words, in the words of one trader, a guy by the name of Alexander Elder, he said it this way. He said, a good trader watches his or her capital as successfully as a professional scuba diver watches his or her air supply. Okay, so if we run out of trading capital, then we're essentially out of business. So money management, really, really critical to what we do in our trading enterprise. There is one goal of a trader's money management system, and that is to reduce the impact of trade risk to the bottom line. Okay, it ensures that we basically live to trade another day, right? And this doesn't mean a trader should gamble their capital and continue to place losing trades when they have no strategy or no plan. What this means is that they need to accept that a well-constructed strategy will have a random distribution of wins and losses, and in a large sample set, one might encounter a string of losses that is consistent with the strategy performance. Okay, so good money management anticipates and prepares for such losing streaks. No strategy is going to profit all of the time without any losses, okay? So let's go ahead and play a quick game right here. This game will show the effect of inconsistent risk and oversized risk on your trading account. And the idea here is that the brick wall is your trading account, if you can think about it that way. And with each losing trade, this wrecking ball crashes into this brick wall or your trading account, taking a chunk out of your accumulated profits. Okay, so I know that sounds painful. It's hard for me to even say it, but I got to help you understand this concept. So I know this is a sore spot for some folks, but you really have to own this. Otherwise, you can really have some great profitable streaks on some good trending markets, and then you end up giving it all back on one or two bad trades. So this can really hurt your confidence and get you back into that revenge trading scenario that we talked about earlier, and then all the bad habits come back in a hurry, right? So what we've done here is we've color coordinated and color coded how much damage each wrecking ball can cause to our account or to this wall. So each wrecking ball has a different color and represents varying amounts of risk. Okay, so we have these divided up into basically 4 groups of risk spanning 1% on the low end to the high end of 25%. Let's see visually what each risk does to our trading account, but first let's consider the following scenario. The trading strategy that we have has an expectancy of 70%. Okay, that's a win rate, and the probability tells us that we may easily have 3 losing trades consecutively. So let's go ahead and see what happens to our wall with each wrecking ball. We're expecting to win 7 out of 10 trades, but we are going to have 3 losses out of every 10. We just don't know what 3 trades are going to produce those 3 losses. Now, I know everybody wants to be in the top left-right corner, right? Or in the top left corner. There's a minimal amount of damage to that wall and to that account, but you have to understand how to get here, right? In this example, we've looked at the application of a consistent risk amount being something like 1%, 5%, 10%, or 25%. So as a trader uses more and more risk, it becomes evident that it's very simple to lose most, if not all, of the money in one's trading account. So looking at the result of the bottom right corner wall, 3 black balls in a row would lose 75% of the trading account in just 3 trades. So to come back from this type of a drawdown can take a really long time if it happens at all. And this is why traders often choose to employ a small risk in their trading plans, as in the wall on the top left side right here. So this is much more sensible. This wall then illustrates the impact of unexpected strings of losing trades or periods of drawdown, with the account damage being minimized. Okay, capital preservation, really the name of the game here. If you don't do it, you could very easily be out of this business of trading. So we're looking for consistency. We're not looking to hit home runs. So let's look at what happens here if one were to employ an inconsistent risk management plan. Firstly, one would need to decide which trading opportunities warrant more risk, but given that it's impossible to know the outcome of a trade in advance, this is a very high-risk plan to follow. But let's go ahead and use a hypothetical example to illustrate the point here. A trade sets up and we decide that it's a great one. We haven't seen this one that good all week long, so we decide to risk 25% on it. We're going in big, and the trade ends up being a loser. Okay, we then decide that we don't want to risk another 25% because we're still feeling the sting, and we don't want to risk 25% on the next trade, so we go ahead and we revert back to our original 1% risk plan. So assuming we are trading a strategy with that 70% success rate, we would then need to take 37 trades at a risk of just 1% to just get back to break even. Okay, I mean, I think you get what I'm saying here. This is not only a waste of time, a waste of capital, it's a waste. Okay, trying to employ a variable risk management plan is risky, and you should definitely avoid it. It's really up to you as a trader to understand the risks and trade accordingly in order to suit your own trading plan. Now that you understand the effects of risk management and trading account, how will you decide to handle the following? Okay, here are some money management questions that need to be answered in order to be a part of your trading plan. Any money management strategy would usually stipulate a stop-loss location for all trading strategies. Okay, each trader has a unique approach to the markets, and that includes where and whether to use a stop-loss. It's advisable to find out what works for you. The strategies that you're learning have a predefined stop-loss plan, and there's no other way to use the strategies, otherwise you're not employing them correctly. An acceptable reward-to-risk ratio for each strategy would be stipulated in our money management plan. Okay, in other words, how much capital are we willing to risk for what potential profit? The risk management aspect of a money management strategy would stipulate the percentage of our trading capital that we should risk on each trade, or how many open trades are you limited to at any one time. So a good example here, you could risk a maximum of, say, 1% of your trading capital, which is very common among professional traders. You could have multiple trades open simultaneously, but those trades are limited by your total account risk. Okay, so although there are many risk management techniques available, like stop losses or limiting the percentage of capital at risk per trade, but there's no way of completely eliminating the risks associated with Forex trading. Okay, in order to extract money from the market will force you to assume some risk. So we need a risk management plan in order to do that for ourselves, and we'll take a closer look at this next week in part 4 and show you how we do that. And the spotlight here is on next week with our final session being part 4 of this Forward Thinking Traders series. So let's go ahead and take a look at what's coming up. And in part 4, we'll bring in the trade strategies. You'll learn the trend flow strategy right here, which is how to identify a strong trending chart with predictable price action, then utilize the strategy to buy or sell pullbacks within that trend. This is a very active type strategy, and it's going to produce many trade setups within every strong trending market. Then there's the momentum breakout trade strategy right here, where you'll still be looking for a strong trending chart structure, but the setup will be a breakout going in the direction of the predominant trend. Okay, we'll show you how to combine the technical factors to arrive at a very high probability trading scenario when buying or selling breakouts. So these strategies will be the recipe or the methodology of how to combine multiple technical factors to help determine a precise entry, a precise stop, and profit targets for your trade setup. And by the end of this course, you'll have 2 trade strategies in your bag to trade a variety of markets across all time frames. Okay? So concluding our session for today, I certainly want to thank you guys all for joining us and hope you enjoyed the presentation. I would certainly welcome the opportunity to work with you in whatever capacity that you may require. The Oana team is available 24 hours a day to get in touch with us. Here's some contact information for you. You can visit us on oana.com as well for more information or to open an account. Once again, I'd like to thank you guys for your attention and the interaction. Hope you found the content useful. We'll stay on a while longer to field whatever questions you may have. If you are leaving us, again, check out the survey. It's a short one. Just fill it out. Let us know what you liked, what you didn't like. We're always